Welcome back, everybody, to another episode from Coin and Capital. It's Chris, and here on this channel, charts, macro, finance, data, we talk about it. We break it down, try and find parallels, try and derive some truth from the noise, because boy, is there ever noise in the news and in the markets. And I've made it my job to learn from it and to help you guys learn as well. And today, Bitcoin and the Bitcoin bears are back in the hot seat. We're going to talk about Bitcoin. Is it really over? 84K. The cycle topped. But what if I told you there's more? So we're going to look at some technicals. We're going to look at the macro behind all the market moves, the macro that drives everything, all the prices we see today. And then also we're going to get a sneak peek at some of my own personal modeling that I've been building to give to you guys to help bring signal and clarity to your investing game. So stick around. Let's get right into it. Right away, guys, into the Bitcoin technicals. So we have the Bitcoin weekly chart, and there's a few things I wanted to present that will give us a good idea just from a technical bias, okay? One thing I like about technicals, if you choose the right ones, then the answers become pretty objective. However, there is a bad side to technicals where you put too many things, you pick and choose, you cherry pick which ones you're using, and then it becomes a little more subjective. But I like to keep it simple. No more than 2-3 things on a chart at a time, and those 2 to 3 things are usually Fibonacci retracements, RSIs, and then a 200 moving day average, which I'm not showing right now. However, Fibonacci retracement and RSI, what we're going to talk about today. So on the bottom is the RSI. For those of you who don't know, RSI, oversold, overbought indicator. On the daily, on the weekly, on the monthly, very powerful signal. Okay, and what we have right now is the daily RSI. This is the daily Bitcoin chart. My apologies, I said it was weekly. It's the daily. What is this reading? Oversold. Okay, the last time we got this reading was tariff shock. The last time after that, the ETF 7-month chop. And then times before that, literal Bitcoin bear markets. Okay. Why is this relevant? Well, because every time the RSI hit undersold levels, we proceeded to rally, right? So from the bottom bear market, we rallied up to 60K. And then from the ETF chop, we rallied from 50 to 100. And then from the tariff bottoms, we rallied from like, what is that, 70s? 70s to high 60s into the 120s, okay? And now this completely contradicts the models people are rolling with right now, right? If we're rolling with the 4-year model, then this is when people are thinking Bitcoin is topped. So then the RSI being oversold is no-brainer and signals pile on, right? Sell, 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 exit, 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 hopefully realize profits, that kind of thing, right? Blood in the water, we sell the blood. That's what it's thinking. However, when we look at other confluences, especially the macro backdrop and this model I'm going to show you later on, we begin to, or at least I begin to form a different opinion, because the confluence begins to stack towards a more bullish stance, okay? Now to support the RSI, we have the Fibonacci retracement. I've talked to you guys about this before on this channel. A very powerful indicator as well. It measures 50, 60, and then 78% of the original dealing range. And for those of you who don't know, these are prime retracement spots to find discounts. Okay, Bitcoin's price, we've overshot the 78, which is a clear signal that, again, oversold, and perhaps emotions are getting out of check, leading to this oversold predicament. Okay, and when emotions get out of check, this is what we call reflexivity. So we overextend to the downside, and eventually we have to snap back to reality, right? And the reality is Bitcoin is valued higher than what it is now, right? 84K is valued, and perceived value is more, right? So then when emotions become grounded again, price reverts back to fair value. And then moving into a few macro signals. These I've talked about like almost every other video on this channel. Why? Because they're some of the most powerful signals in macro, and I think they produce some of the cleanest signal that we as retail investors have access to, right? We can just go on TradingView and get 10-year data and then DXY data right at our fingertips, right? We don't have to pay 25 grand to go on Bloomberg and whatnot, right? This is free, and it tells us a lot. Right now, these two signals, the 10-year and the DXY, are contradicting each other right now. So the DXY is providing a headwind for all liquidity beta assets, risk assets, right? So think equities, crypto especially. Why is that? Because the DXY, the dollar index, is very good proxy for liquidity easing and contracting conditions around the world. And when the DXY is high, say above 100, it starts to constrain on liquidity, because excess liquidity then floods into the dollar and dollar assets. Okay. However, when there's a weaker dollar, that excess liquidity gets redirected into equities and then into crypto. Make sense? And right now, the DXY is pushing 100 level right now, pushing back into that fair value. I think the next few weeks are going to be very crucial to be watching this signal. If we pop into the 101s, 103s, not so good. Okay, that's a red flag on my end and in my models. Okay, adjust positions when that happens. However, 100 right now, 100 DXY, minimal headwind. So there is a headwind, but it's slight right now, offset by things like a downwards trending 10-year yield. Okay, so we know, we've talked about this on the channel, the Treasury is doing these buyback operations, suppressing yields, trying to get them down, because they have so much debt to refinance, right? 10 trillion refinanced on the long end. Freaking expensive, guys. So they need to buy, inject all of this liquidity to suppress the yields. In turn, that has the spillover effects, right? We know this. Yield curve control is positive for equities and for liquidity beta. Okay. When I say these two things are contradicting each other, the DXY is the headwind, whereas the 10-year trading down is the tailwind, right? Two opposing forces. And just to confirm that, we can see it being expressed throughout the markets right now. So we're looking at gold to the top left, and then the S&P bottom right. And we're seeing this kind of uncertainty, not sure whether we're ample liquidity, not sure if we're risk off, being manifested in commodities and equities alike. So gold has returned to its most recent weekly fair value. Same thing with the S&P. Right. And so I believe both of these are very good proxies for dollar debasement and liquidity gauges in the system, right? We know the S&P index and the indices reflect almost one-to-one money supply growth, right? So when the S&P is chopping like this or even trading down, what we can assume is that there's the liquidity contraction in the system right now, right? And we know events in real life support that, right? We've had the government shutdown in the US and then the buildup of the TGA, right? Both of those things are risk adverse and then anti-liquidity. And then also in gold, in the commodities market, so we've kind of established that the reason gold has been ripping so much is because of this dollar debasement, right? The dollar debasement trade, as JP Morgan and all these banks are calling it now, right? That's the Bitcoin trade. That's the gold trade. Trade your fiat for something finite that hedges against debasement. When gold stalls out, that's either trend exhaustion, which it doesn't look like, or that's signaling that the money printing, the excess liquidity is kind of drying up for the moment, and a distribution is taking place like we saw in Bitcoin, right? So that's kind of my read on the equities and commodities right now. And I think Bitcoin is expressing it as well, right? We went through that big distribution phase and then the fear kind of seeped in. That fear caused that reflexive feedback loop and we ended up puking quite a bit more, running through some leverage. That tends to just over-exacerbate things a bit more. However, I do think it's very similar to what we're seeing in the gold, in the commodities, and in the equity markets. Now, my read on all of this is that the cycle isn't over, right? And in fact, this is just an interim pause, rebalance, distribution, and fear-driven reflexive push to the downside, okay? The reason being is because my time frame has been extrapolated beyond this week, this month, the next 2 months, the next 3 months even, right? Because my models, the things that keep me sane during this market turmoil, map conditions and price expectation 6 to 12 months out, right? With that being said, when things are mapped 6 to 12 months out, it makes it way easier for someone like me to ride out these gut-wrenching corrections. Yes, I feel the pain, right? I check my portfolios and I just shake my head and then go touch grass, right? And then maybe even consult the models I'm building for you guys, right? And so far, the base, the magnum opus, the interconnecting matrix of all my proprietary models is telling me that the macro has not broken yet. The macro is still supportive of liquidity beta, right? Of risk on assets, equities, and crypto. However, there seems to be some narrative issues going on, some psychological issues happening in the crypto markets. Because this score right here at the top, at plus 61 basis, is telling me that this cycle is pushing out of a plateau and ready to expand over the next 6 to 12 months, right? And you can see here, it's giving me an action keep core positions and add into strength when liquidity is ample. Below that, we have a few individual model readings. So the macro is good. The liquidity engine, how that liquidity is flowing through plumbing, is pretty good. However, that reflexivity is where the problem comes into play. Reflexivity has to do with psychology and narrative. And then finally, we have the collateral side of things. So leverage in the system, Bitcoin specifically being used as collateral, which is good. What this tells me is that everything is functioning properly except the psychology of crypto. So with that in mind, how do I weather this market right now? I pay attention to my psychology, right? My model is telling me where and what is broken right now. So I can focus all my attention on making sure that is the strongest part of my investing. Okay, what if liquidity was the problem? If liquidity was the problem, I would look to take action to either protect or exit some of my higher risk positions and maybe exit some of my leverage. Right. Okay, what if that score dropped down to 40? I would be given actions based on preset conditions. So I leave my emotions out and take action based on signal. Right? Not what these crypto bros are saying on Twitter. Okay? That is my main goal. That is what I'm trying to do with these models, with this new platform and software I'm rolling out for you guys, is to make this journey simpler and derive easy to read signals so you don't have to go through hundreds of charts, data providers, spend hours a day decoding, putting pieces together. It's time consuming and it's energy consuming, right? So with these models, it takes all of that for you and synthesizes it into actionable insights, right? Which is why I can do this and stay sane, right? Because I'm not spending all day on Twitter trying to find sentiment. I'm not spending all day scrolling through charts, trying to find this and that, right? I look at charts for maybe 30 minutes, right? The rest is consulting my models, refining them, and acting accordingly, okay? So hopefully in the next 2 months, 3 months, I will bring this product to life for you guys and have some of you try it out to help you along with your investing journey. But what can we derive from this video now? The technicals on Bitcoin. Oversold to the max, right? Oversold to the max. The macro. Supportive with some minor headwind, okay? Add to your positions. Add to the core positions on the dips, right? 6 to 12 months out is a very positive scene, right? So if you can remain solvent for that long, you are good to go. Finally, the psychology and the narrative is broken right now, okay? The best thing you can do is turn off your phone and stay sane, okay? Ride it out over the next 3 to 6 months and you will thank yourself. I promise you that, guys. If you enjoyed this video, drop a like, leave a comment, let me know what you think of these models. Let me know if you want to see any more of them. Make sure to hit that subscribe button. Catch you guys in the next video.